Go.
Here we go. Hey, what's up, guys? Happy Friday. Happy Friday. Thank you for joining. Can we just get a quick call and response? If you guys can hop in the comments, let us know if you can hear and see us okay, and we will get going. There we go. Archangel 3579. Happy Friday to you as well. Good to see you. I'm not sure if this is a new viewer, but welcome.
What's up, Archangel?
Either way, welcome. Good show. Good show coming. Scary, a little bit scary, but a good show.
What's up, Amari?
Oh, that's Chris.
Chris
okay.
Campbell. What's up, brother?
My God. Chris is actually going to call in today.
Awesome.
So excited to hear from Chris. What's up, Omari? Good to see you. I think that's Eddie with the warrants.
You said today's going to be scary?
Well, maybe not scary. Maybe that's too strong.
Okay.
How would you?
It is scary news.
Yeah.
It's very scary, actually.
It's sobering. A less charged word. Should I say it's sobering?
I mean, it ties to one of the most horrific experiences in my life that landed me in the hospital.
Wow.
So we're going to talk about what we see in the market today and how it relates back to me being in the hospital at one point in my life.
You said you ended up in the hospital behind the news that we're going to talk, or something related to the news that we're going to talk about? Put you in the hospital?
Put me in the hospital.
Come on, bro.
Yeah. I'm going to try to get through today without crying, V.
You want to try?
You always no promises. To make a brother cry, but I ain't making no promises.
You make no promises. Hey, man, if nothing else, we keep it real and we let you guys in case you haven't been able to tell that. How many times have we cried in various reasons on this show?
Oh, man.
Not a bunch.
What's up, Grill Master? How do you say that? Was it a noise or anwa?
I'm not sure, actually.
He called
Grill Master Lou
told us how to pronounce it one day. What's up, Mr. Jennings?
We got two people that are showing up as Facebook user. One of them I'm pretty sure is Eddie. But can both of you guys, not Eddie, because I know you got warrants, but can the other person click that link so we can see your name? Can't have Eddie do it. Eddie got warrants.
They looking for him.
They looking for him.
They looking for Eddie.
It's Miguel. Okay, cool. That's what's up. Luke said he had to redo the StreamYard. All right, guys, we're going to get going in about 30 seconds. Here we go. This is probably one of those shows that you're going to want to watch twice. And I say that because there's a fair amount of, it's a little, not super technical, but there's some things that we need to break down to make sure you understand what's going on. If you got the email, we talked about, what happens when lenders run out of money. Like, that seems like backwards. Like, that's not supposed to happen. They have the money. How do they run out of money? Well, it's happening. It's happening. And so we're going to go over that. But as we go over that, we're going to have to unpack some other concepts that are sort of embedded within it, right? How we even got here. And so it may be a show that you want to go back and watch again, maybe a third time. So we're going to try to keep it interesting. We're going to definitely try to keep it entertaining. But there's a lot coming at you because there's a lot going on. So let me do a very quick intro, and then I want to get you guys involved.
We're going to talk a little bit about, you want to give them an introduction of what we're going to be talking about today?
I'm going to do both. Yeah. So I want to welcome people to the show, first of all, because if you've never been here, you don't know what you signed up for. Maybe you got a random email. This is something that we do every Friday. It's sponsored by REI Skip, but as I always tell folks, this is really not about product at all. It's really about Justin and myself bringing on experts. We have a level of expertise ourselves about real estate and about the economy, and we want to share that with you. And when we see headlines in particular that we think are of interest to you and your business, because our audience is mostly entrepreneurs, we want to bring you that news in as clear and concise a way as possible. So today, what we're talking about is you've heard us talking about recession for a long time. You may even recall us saying that we had a big internal meeting months ago where we said to the team, forget what the news says, we are in recession already. Maybe not officially, maybe we don't have 2 quarters yet, but we are in recession. And here's why we think that. Well, the other shoe is starting to drop. And specifically, what we are seeing is that mortgage lenders, are under an awful lot of stress. An awful lot of stress. And when the folks who have the money, who are supposed to lend you the money, run out of money, that's a bad sign. That's a bad sign. So that's what we're going to get into.
I know what they're going through.
And Justin has some very personal experience to relate to this. Justin was in the mortgage business during the last downturn, we call the GFC, the Great Financial Crisis, and has a very personal story to share, which he is going to try to get through without tears, although he makes no promises.
Make promises. I'm gonna try my best.
I'm gonna try his best. But, I want to get to that story. I want to share what's happening in the broader market. And then we have somebody who wants to call in with a deal analysis. It's a lot to get through. So I want to kick this thing off right now. Can we go ahead and get started? Just, you cool with that?
I'm good.
Let's jump right in. So what I would like to do to jump in with, do me a favor, hop in the comments. I'm going to share my screen with the answer to this question, but I want you to tell me what you think. Who is the biggest, what's the name of the biggest mortgage company, biggest mortgage lender in this country? Is it JP Morgan? Is it whoever you think it is? Hop in the comments really quick. Tell us who you think is the biggest provider of mortgages in the United States. Hop in the comments. Let us know right now.
Is this a trick question?
No, it's not a trick question. It's a real question. I really want people to jump in. Okay, so somebody says BlackRock.
We got BlackRock.
Somebody said Fannie Mae. Luke said Rocket.
Mike said J13's coming.
J13. Remember, what was the horror guy? Was it Candyman? Candyman coming. That's how they talking about you now.
I'm gonna start wearing a trench coat with a hook.
Start wearing a trench. Right. All right, we're gonna shut it down here in a second. Somebody said FHA, Fannie or Wells, mother effing Fargo. Somebody said Fannie. And this will be interesting because maybe we can break down a little bit about what role Fannie plays in the mortgage market. But this is very
and FHA doesn't. Just so you guys know, like we'll describe all that later too. Seems like they should, but they don't. FHA doesn't actually lend money.
Right.
They're more of an insurance program for loans, but they don't actually lend the money.
Yeah.
Which is interesting because we do call them FHA loans, right? But they didn't actually do the lending.
Right. Exactly. And AJ hopped in. Similarly, Fannie is an investor. But Fannie doesn't originate loans. And again, we can get into some of that. So it looks like most people were saying either Fannie or FHA. And then we heard Wells. And then my guy, Luke, said Rocket Mortgage. Let me actually pull up on the screen real quick. Here is who the top mortgage providers are in this country as of 2021. Top mortgage lenders of 2021. Can you guys see that? Rocket Mortgage. My guy Luke got it right. Okay. But the thing that I want you guys to pay particular attention to, and kind of the thing that we want to really spend some time on today and double tap on, is the fact that there's not a whole lot of banks in here. I know some of you guys said Wells. I think I even heard somebody say Chase, but let me read you guys the list of the top mortgage providers in this country. Rocket Mortgage, number one, the biggest by a large margin. Rocket originated 1.2 million loans, $340 billion in mortgages last year.
Man.
Number two, United Shore Financial. You probably never even heard of them. Number three, maybe you heard of Loan Depot. Not a household name. you don't get to a bank until position 4. The banks don't even make the podium, y'all.
Nope.
So what does it mean when the banks who you think of as mortgage providers, as mortgage lenders, don't even make the podium? How far we got to go to get another one? Is it next? No, Freedom Mortgage is next. And then we get to another bank, JP Morgan. And then it rounds out Fairway, Caliber, Home Point, PennyMac. The point is, guys, banks have not been the main providers of mortgages in this country for a very long time. And that has some very specific implications for housing markets and for the economy writ large. So, Justin, do you want to maybe frame for people kind of what it means to be a non-bank lender? Maybe we just sort of unpack that a little bit and then talk about the trouble that they are having, these non-bank lenders.
Yeah, so just so you guys, so we're all operating on the same definition. So today we're talking about the impact that non-bank lenders, you may have also heard the term non-Q or QM lenders, non-QM lenders. They all sort of represent the same thing. Back in the 2008, 2007 crash, we also had another term. They were called Alt-A lenders, alternative A lenders. These are all the same terms or terms that are used to describe the same type of lenders, meaning they are not your larger financial institutions, which means that they also have lighter regulations than, say, the large bank lenders. But the other thing that they have is capital restraints. Another term that you may hear is correspondent lender. And you'll hear later my story about when I was a correspondent lender and I actually ran a correspondent lending shop and the things that I saw that led to the 2008, 2009 downturn. And some of the same things we are seeing now, we are seeing today. And let me tell you something, guys. It hit the non-QM, the non-bank, the Alt-A, basically what I kind of sum up into one term, the correspondent lenders. It hit them the same way in 2007, 2008, 2005, 2006. The same exact way that it's hitting them now. And guys, you need to be aware of what's happening and you need to understand how lending works at this level. Because what Vince said is absolutely true. Just like the mom and pop investors still own the investment market over the institutional lenders, these lenders own the mortgage market compared to the large banks.
Absolutely. So here's the thing that is troubling to us and got us thinking, man, we need to dig a little bit deeper and maybe even do a show on this is tell me if you guys can see this, right? These guys were on that list. Remember the list that I just showed you of the top lenders in this country, Loan Depot being one. I think they were in the number 5 spot. They are cutting. Now I want you to read this headline carefully. They are cutting 2,000 more jobs.
Wow.
2,000 more jobs cut this year as a decline in mortgage origination seen is accelerating. Look at the date on that. That's July 12. That is last week, fam.
Right.
That's last week. Let me dig a little bit deeper into this article, and then I want to unpack a little bit more and get into some of these definitions. So Loan Depot, it says they had already cut 2,800 jobs this year, and now they're cutting an additional 2,000. Talking about 5,000 jobs cut.
Wow.
This year. Okay. Let me quote them. We anticipate continued challenging market conditions with mortgage originations projected to decline by roughly half in 2022 from last year, including an accelerated decline in the second half. So that means it's only going to get worse.
Yeah.
Only going to get worse in the second half of this year, followed by a further decline in 2023. It's bad. It's getting worse. And the bad is going to speed up.
It's not bad. It's super bad.
It's what did Elon say? What did he say? I'm feeling super bad about the economy.
It's super bad.
This is what that's Elon speak. Yeah. But
now,
this is what his advisors and stuff are telling him.
Yeah, and we're going to get into later, like, as this is just really what they tell the exterior effect, right? So we know that mortgage originations are going down because of all the obvious things, right? Interest rates are rising. People aren't, willing to get mortgages the same way. They're not refinancing nearly as much. But what we're really going to get into is what's really going on behind the scenes at these companies, at these correspondent lenders. And another way of thinking about correspondent lenders versus like a bank, basically a bank has their own money. Correspondent lenders do not. They don't have their own money, right? So they actually have to use a huge credit card in order to make these loans, which is called a warehouse line. And we're going to get into that a little bit later. But understand the difference between a correspondent lender and a bank. And most of the mortgages in our market, in the mortgage market, are through these correspondent lenders, or AKA non-bank, non-QM, Alt-A lenders.
And just, I want you to actually define for people a little bit more about what a correspondent lender is, and even what a warehouse line of credit is and how it works, because a lot of the pressure that you were talking about that you and your team were under back during the GFC had to do with that warehouse line. I'm not sure. Do you want to do it here, or do you want me to share maybe just some other market stuff that's going on?
Yeah, maybe share some other market stuff, but
Okay.
yeah, definitely we need to get into it. And why it's important that you guys understand this is because what's really happening is how these lenders actually secure money, and who secures that money, and whether or not that money is available. So correspondent lenders have to get this huge warehouse line in order to originate loans. They sell their loans, right? They don't keep them, whereas banks do. But they actually have to pay for some period of time. And I can break down deeply how that works. But what you need to understand is the fact that the very first signal that we saw back in 2006 and 2007 was what we called the credit crisis. The liquidity froze in the mortgage market. And what it means is that lenders like us, the correspondent lenders, or like I was, didn't have money to lend because the credit lines froze. The warehouse lines froze. And guys, this is exactly what's happening right now that's leading to why all these non-bank lenders are actually having to fold shop. It's not because of necessarily the decline. Now that's an effect, but in the end, we're going to kind of break down how it works behind the scenes to get to what's actually happening in the market. And then next, what you guys have to do in order to prepare and how you can actually take advantage of this situation.
Absolutely. So let me share a couple of other ones, because I want you guys to do some research. And then I do want to quickly get into, Justin, because you have a unique perspective. You can give folks an inside look that even these stories that I'm sharing don't really capture what it means and what it takes to run one of these operations. So I want to get to that as quickly as possible. But let me just share a couple of other names, right? You guys may have seen. So here's just an article that came out: lessons from lenders Q1 earnings amid epic volume drop. Rocket companies, which we talked about, that made the list. A lot of these guys, gosh, I feel like they might need to hear from you to even understand some of what's in these articles. Let me give you the short version, then we'll go to Justin, and then we'll come back maybe to some of these articles. Because what you're going to understand after you hear from him, you're going to better understand how lenders actually make money on mortgages, right? And then once you understand how they actually make money on mortgages, you will understand the big squeeze.
Yeah. And
I think
AJ has a question here about, isn't it important to know what jobs are being cut? Like if it's excess staff that was brought on during the run-up, then reducing staff isn't really that bad. Well, we're really going to get deep into that. And it's not necessarily about the jobs. That actually is a symptom. That's a byproduct of what's going on. And I think some of the articles, Vince, that you want to show actually will tell the story as to why they're actually filing for bankruptcy. So, maybe we should talk about why Sprout Mortgage is filing for bankruptcy, why FGMC, First Guarantee Mortgage Corporation, is filing for bankruptcy, what's kind of leading to that, and how this was predicted back in 2019 by a professor at Georgetown University that we actually can show a quick little video of him predicting that this was going to happen.
Yeah. So why don't we do this? I think people should hear from you, man. I think that you're going to be able to contextualize this again in a way that even the articles really can't. Take them back to 2006-07, when you guys were running the mortgage operation, what your role was. And in doing that, I think you can explain better how people make money, how your shop made money on mortgages. And then when the light switch flipped, what happened? And then we'll bring it back to current day. Let's do that.
Okay, so this is the part where I start crying?
This is the part where you start crying. So everybody listen.
Cry.
It's okay for men to cry. There's nothing, don't let anybody shame you about it. There's nothing wrong with that.
Okay. All right, guys. So look, so back in 2005, 2006, I was operating a mortgage shop. So I first started what was called a net branch of a larger company. Actually, I started out brokering first, then a net branch, and then eventually became the VP of operations for a mortgage corporation here in the Northern Virginia area. And we were a correspondent lender. What that means is that we didn't actually have our own bucket of money. We didn't have hundreds of millions of dollars sitting in the bank. What we did have what was called, thank you, Chris Campbell, I appreciate that, because brother gonna start crying in a minute. What we did have was a warehouse line. Some warehouse lines can be $10 million, they can be $50 million, they can be $100 million. But essentially, really what it is a credit card. And so if I give Chris a loan, if I give AJ a loan as a mortgage shop, a mortgage originator, what happens is that I fund that loan from my credit card, from my warehouse line. Now, once I do that, let's just use easy math. Let's say the loan is for $500,000. I have to, as a company, put in what's called the haircut. And all the haircut is the percentage that I have to give. So the warehouse lender who owns my big credit card says, you know, hey, Justin, if you're going to lend AJ $500,000, you got to put in at least 2% of the loan. 98% you can get off of the credit card, 2% you've got to put into the loan. So I'm like, okay, cool. So what's that? $10,000 that I've actually got to put into this loan. So I put in my little 10 grand. They put in their $490,000. I originate the loan. Now here's the problem. The warehouse line interest rate is probably 9%. Really depends on my ability as a company to negotiate a great rate. If I'm a smaller company, I've got a really high interest rate. It's usually variable. It's usually tied to LIBOR. It's usually tied to, you know, or prime, some type of rate that I can't control that changes from month to month. So even though I originated this loan, especially in a low interest market or low interest environment, if I gave AJ that loan, because he's got fabulous credit, at 3%, 4%, I'm paying 9%. So there's the problem, there's the rub. I've got this difference between 3% of what I originated that loan at and the 9%. So my job is to get that loan off our warehouse line as fast as possible. Right? And a term that you use for this is called secondary marketing. Now, what do I do? Who do I sell this loan to? Well, back in those days, we were selling loans to these large institutional buyers like Lehman Brothers, Bear Stearns, IndyMac Mortgage, Countrywide. I can go down. Guess what, guys? Every single last one of those companies doesn't exist anymore. And the same thing is happening today. These smaller lenders who are originating the majority of loans out there are doing exactly what I tried to do. They're trying to sell to these larger lenders. They're trying to sell to the JP Morgans. They're trying to sell to U.S. Mortgage Corporation. They're trying to sell to Fannie and Freddie. You name it, they're trying to sell to them. But guess what, guys? These companies aren't buying mortgages right now because they're scared about what the economy is going to do. So what happens is these larger warehouse lenders see this and they come back and they say, Justin, you know what? You had 2% as a haircut, but now we've got to increase that to 4%. Now you got to put in 4% of your loans. Well, guess what, Justin? It's getting even worse. Now you got to put in 10%. Oh, hey, Justin, guess what? You got to put in 20% now, and we need it retroactive to the loans that you originated over the last 90 days because it's getting bad out here. And Justin doesn't have the money. I've got to pay my loan officers who are showing up talking about they can't pay for their light bill because they're salespeople. I got to pay for my processor who's got 3 kids and a single mom. I've got to pay her payroll. I've got to pay mortgages that I've promised, origination fees that I've promised on these loans, and I can't sell to Countrywide because they just went out of business. So then what happens? Justin, you need to get this loan off the warehouse line or we're going to close it. Well, I don't have the $400,000 times the 20 loans that I just originated over the last 90 days. What does that add up to? Millions of dollars. Well, guess what? Warehouse line is closed. Now I can't originate mortgages. I have to fire all my people. I have to close shop. And I have a huge institutional lender with fantastic attorneys that says, Justin, you owe us $8 million. Well, what is Justin left to do? Well, I can tell you what Justin did. Justin was in the hospital, stressed out over this scenario and this situation, and spent years digging himself out of the hole. That's what happened. And that's what's going on with these QM lenders right now, these non-bank lenders. And I can show you something just to kind of prove this point. And this is what makes it hard when you're in a situation where, and guys, if you understand the scenario that I just gave you, if I have to originate loans and then I have to sell them on a secondary market, the idea is that I'm selling them at a rate that's higher than what I originated, and then I can create what's called surplus. Now, the faster I do that, the more money I make. Now, if it took me 30 days and I had to pay that 9% on 30 days, that's not so bad if I'm going to end up selling it, and make the money. That's what you call yield spread. That's how these banks make money, how these smaller lenders make money. It's okay when you've got an interest rate that's actually rising out in the street. I'm sorry, declining. If it's declining, because that makes the paper that I just originated more attractive, because I locked it in at a higher rate. Let's say I locked it in at 4%, but next week the rates go down to 3.5. Well, now the value of this paper that I just locked in increases. But imagine I locked a rate in at 3% and I originated a mortgage, and now all of a sudden in a high inflationary market, interest rates are rising to 4, 5, 6%. Now that money that I've got sitting on my warehouse line with the paper with the loan attached to it is at a lower interest rate, it's declining in value. So not only am I incurring this great interest, on this, the likelihood of me being able to sell that paper becomes less and less and less and less, which causes these things that I talked about. Warehouse lenders saying, Justin, you need a higher haircut. You need to put more money in the kitty when you originate loans, because we need to decrease our exposure. We need to decrease our risk.
So Jay, stay there for 1 second, because I want you to go to the next level down as well. But this is, Luke asks, the sort of specific tactical question, right? And this is what's happening out in the street. He said, what happens? What happens when these smaller companies close up? What happens to those loans that they already have out? There's a real family on the other side of that got to clear to close, maybe.
Exactly. They got to clear to close. And they're actually, the loan actually happened. So what ends up happening in those cases is that the warehouse lender has to actually take ownership of those loans and try to figure out how to sell them. And that's where you see back in 2008, 2009, all of a sudden the federal government started jumping in and purchasing these mortgage-backed securities and these loans off these warehouse lines where they weren't doing it before. The federal government stepped in and actually purchased all these loans.
Right.
That's what happened. So the question now becomes, well, what's the federal government going to do now? Are they going to jump in? Because now they've purchased more loans since 2007, 2008. We have a chart that actually shows that. But let me show you two things quickly, and then we'll jump to what you're saying, Vince. And this is an article, if you see this is an article that shows, what I was saying. And it says, while lower rates should boost volume, the relief to non-bank mortgage originators will likely prove temporary. Now, this was back in 2019. This was predicting where we are today. And this was Warren Cornfield, a senior vice president for Moody's Financial Institutions Group. He said he expected more consolidation when rates were rising in 2016 and 17, meaning non-bank lenders consolidating to become larger lenders. But many of the small privately owned companies in this space have been able to withstand bouts of little to no with profitability. The recent decline in rates should provide further support of these non-banks for the time being. So basically what he's saying is, because rates were declining, they were in a declining market 2017, because the Fed kept lowering rates and making money free, these non-bank lenders were able to sustain some sort of profitability. That's why. But they knew that the minute that the industry would change, or the environment would change, or the economy would change, they would not be able to withstand this change in the market, where interest rates would all of a sudden steadily increase dramatically. That's what's happening right now.
Yeah. And let me show you guys one other thing. So you should be able to see this here. Let me talk about how we got here. Talk about how we got here. Again, very few people had banks, or that list rather had very few banks in terms of the top lenders, and that's been happening for a long time. Okay, non-bank lenders right now, I don't think I said it at the open, are 2/3. It's actually more than that. It's closer to 69%. 69% of all the mortgages that get done do not happen by Chase or Wells Fargo or any other money center bank, as they call it. And here is a chart that shows the banks getting out of the mortgage business. I don't know if you guys can see this, but this is the non-bank share of mortgage originations going back to GFC. So in 2007, they were roughly half, 48.3%. And then they fell off a cliff. They said, you know what? I'm sorry. So 52% would have been non-bank and 48% would have been banks. So the non-bank share plummeted, and then it started to rise steadily because banks got out of the business.
Yeah,
banks said that
they closed. They were in the hospital with me.
Right, exactly. And so what you see is steadily coming out of the crisis, the non-bank share of mortgage origination starts to climb. From this low in 2009, 8.9%, climbing steadily. Mortgage rates are dropping. The Fed is doing all their quantitative easing and all that until they eclipse 50%, all the way up to where they are now. Yeah. 68% non-bank mortgages, non-bank lenders are originating mortgages. So you want to talk about systemic risk. Yeah. You know, you've got 70%, call it, of the mortgages being originated by institutions that don't take deposits. Yeah. And let me show you. They don't have. Well, go ahead. Hold on. So, they don't have deposits, number one, and they also just don't have many levers. They don't have that many levers in terms of how to generate income, right? So Justin talked about yield spread. A lot of them will end up selling off their servicing rights. But there's another chart that I have, and I won't necessarily go into showing that chart, but what it shows is even the margin on that. I'm not sure what you would think somebody would get in terms of selling a book of business, but they've gone from making like 3 or 4 or 5% a few years ago to making just over 1%. Yeah, and the reason, and here's the reason why this happened, right? Because prior to that, these banks were killing it. They were killing the game. And one of the reasons is because Wall Street was so greedy. A lot of people think that the subprime market is what led to the meltdown back in 2007 and 2008. I'm telling you that exacerbated the issue, but that's not what happened. That's not what truly caused it. What truly caused it was these alternative loans. What truly caused it was a very low interest and a false sense of wealth that people were having during that period of time because interest rates were so ridiculously low. They weren't as low as they are now, but this is what they did. They created these 1% mortgages. You guys remember those? Where you could get a mortgage for 1%, but your interest rate was actually 6%, but you were only paying at 1%. You remember those no-doc loans? You remember those loans where people were stepping in the loans and buying multi-million-dollar houses, where they didn't have to prove income? So that's what led to the downturn, and then it became exacerbated by the subprime market and the loans that were being made in the subprime market. So there were no buyers in this secondary market anymore after this because we all got smarter. Wall Street got smarter. And then also regulation came, right? And regulation came, which, to Justin's point earlier, the banks have more regulation than these guys do. So there is even more systemic risk. And I want to come back to the regulation point in a moment, but I want to stay here on exactly what you just said, Jay, and show you that what he is talking about is happening right now. So this is one of the stories that he mentioned at the top, and this is what's happening. Right? You're seeing more and more. So First Guarantee Mortgage filed for Chapter 11 after making a bunch of layoffs themselves. And then if you will indulge me, I just want, because this is really kind of staggering, I want to share with you, I just want to read a couple of sentences from the actual, if you go to Pacer and you're a nerd like me, you can actually pull the bankruptcy filing and it will knock your socks off. So let me just read a couple of sentences. You can see it right here. So wait a minute, are you saying you don't have socks on right now? Is that what's happening? Is that what you mean? How you know I don't have socks on? I really don't. Actually, you know what? I weirded myself out. I actually don't have on socks right now.
Oh
That's
man,
that's
don't
a whole
put your
other
feet near the
conversation.
mic. We're not trying to smell all of that, brother.
Hey, simmer down, simmer down. But look, check this out. So look at the date, filed June 30, right? So this is 2 weeks ago.
Okay.
Federal first guarantee mortgage goes and files for bankruptcy. I'm not going to read the whole thing, but I'm going to go straight to section 4 because that's where they give you the good stuff.
Man, you guys are getting to see the back door.
Yeah, man. This is what nerds like me do. All right, so check this out. So you go to section 4. It says events leading to the commencement of the Chapter 11 case. Continued concerns about the availability and cost of credit, the United States mortgage market, including uncertainty with respect. You okay? You having flashbacks?
Man, yes.
I know you are. I know.
Man, you're gonna make me hyperventilate on this show.
Y'all pray for my man because he's having PTSD. But I know it sounds really eerily familiar because Jay hasn't heard me read this. So, but bear with me if you can. If you can stomach it, Jay, just bear with me as I read this. And remember that this was written 2 weeks ago. 2 weeks ago. Okay. Concerns about the GSEs, the government-sponsored entities, the war between the United States and Russia, trade wars, COVID-19, et cetera, et cetera. Okay. And then it goes on and it says, after many years of historically low inflation and interest rates for mortgage loans, due in major part to the Fed's lowering of interest rates to near zero, mortgage rates in the U.S. are experiencing steep increases as a result. For instance, mortgage rates have risen from 3.2 to 5.7% in May. Now is where it starts to get juicy, right? Limited housing stock also contributing. And then the residential mortgage industry is also one of the most highly regulated industries in the U.S. Now we go to the debtor's liquidity crisis. It says the debtor, which is first guarantee, the debtor's business has been directly and severely impacted by this series of macroeconomic challenges. The intense competition for mortgage originations, right, resulted in a sharp decline of debtor's performance. And then it says, they lay it plain right here. It says, unfortunately, these trends have continued into 2022. And for the 4 months ended April 30, the debtors generated $23 million in losses. This is in part due to low origination volumes. And then it goes on and says, and this is the part right here. So check this out. It says the combination of continued losses and volatile daily margin calls. Grab something stable, Justin. Grab something stable. The combination of continued losses and volatile daily margin calls on hedge positions has led to drastic reductions in the debtor's unrestricted cash, creating a liquidity crisis. By mid-June, the debtor's management concluded that they could no longer continue operations without a significant injection of new liquidity, as 1 or 2 days of significant margin calls could leave them without any cash. And listen to this part carefully. Despite their best efforts, the debtors were unable to obtain additional equity capital or financing. The language is relevant. They went to everybody. This is one of the biggest lenders in the country. They went and tried to get another version of a warehouse line. The financier said, nah, your business is looking shaky. They went to the equity markets, the people who like risk. And the equity market said, nah, we don't want any part of that.
And that next sentence is exactly what I've been telling you guys too.
Despite their best efforts, the debtors were unable to obtain additional equity capital or financing. As a result, the debtors determined that in order to protect part of the current pipeline, loans not yet funded, they needed to suspend all new loan applications, suspend all correspondent lending, cease all hedging payments, and significantly reduce their workforce.
And the hedging payments, guys, were the haircuts that I talked about. Those are the haircuts.
This is what's going on right now.
Guys, this is hard for
me to
read. It's actually hard for me to read because, and I opened up like, as what led to 2007-8 crisis was not subprime market, it was a liquidity crisis. I told you exactly those exact same terms. There was no liquidity in the market. That is exactly what happened. It was a liquidity crisis that came first, and then the bottom fell out. It's the same exact thing.
It's the same exact thing.
It's exactly what happened.
Let's pause here for a moment and just have the thought exercise, us, and you guys join in as well if you have thoughts or comments. I mean, it's not the same as '08. I do think that the quality of loans and the quality of borrowers is better, but the mechanics of losing liquidity are what they are.
Yeah.
And so could we have a situation, Justin, where
And
a housing crash,
in the end, does it matter about the quality of
and
the
that's where I'm
loans,
going. Exactly.
right? It doesn't matter. What matters is that there's no market.
Right.
That's what matters. There's no market for these loans. There's no originations. There will be no lenders out there to actually make and fund loans when people want to buy a house. It's going to all of a sudden go down to a very select few of corporations that can offer it, and they're going to have much more stringent buying terms. As this impacts a lot. This impacts people's ability to buy homes. This impacts pricing. This impacts.
Unpack that. Do that second derivation and third. Go exactly where you're going, but explain how it makes it down to the ground.
Okay, so this makes it down to the ground because now if all these smaller lenders go away, then who's left to lend the money?
Right.
Right? So there's going to be just large banks left. And if those large banks are still in the market, they're going to be more conservative in how they actually lend. And if they're more conservative in how they lend, that means there's just not going to be as much money available out there for people who want to buy homes. Now, couple that with what we're also seeing, which is a lot of these investors that we've been reporting, like these buyers, these institutional buyers who've been buying thousands and thousands of doors, are going to be dumping these homes into the market. They're trying to sell these homes now, right? So now we've got all this inventory out there. We don't have people to buy it. Now, what we won't have like we had was a foreclosure crisis. We won't have that, which is good, right? But what we will have is a whole bunch of housing flooding the market and no ability to buy them. There's going to be a gap. So it's going to impact prices.
Are you able to see that headline? I'm not sure if it's coming up okay, but it's the Starwood Capital story. That's the one you were referring to?
Yep, Starwood Capital explores sale of 3,000 homes for $1 billion.
Right. So you've got the confluence of things like Justin is saying. You got 2/3, more than 70% of the lenders are getting the big squeeze because of margin calls and liquidity constraints. You've got less money in the system. So the banks that do stay in the mortgage business, and most of them don't want any parts of it because they make more money on trading. They make more money on investment banking. They make more money. They have lots of other levers, right? There's not much cash left in the system. And what was already a very stringent credit environment, which Justin, you and I talk a lot about, and we have shared here on the show here before, it's going to become even more stringent.
Yeah.
So all this says that activity has to fall, and precipitously.
Right. And so, and then I see a few comments, people are asking, well, what happened to all the liquidity? Where did it go? It's, it's not there, but is it available? Is it available to tap? Well, it is different, right? In the fact that some of these larger institutional buyers have liquidity, the non-bank lenders don't, right? But the larger lenders do have liquidity. The issue is that they're not willing to put it out in the market. They're pulling back. So, you can look at what Jamie Dimon has said about what the market is, what JP Morgan is doing, right? And actually have that statement from him. Vince, I don't know if you actually have it, but you guys, let me show you what Jamie Dimon said. Let me pull this up in a second.
And Chris Campbell, to your point, and I still want to carve out some time for Chris to share his story, but this is critical. Now, this is a story that I have shouted out here on the show, and I tend to agree that I have tended to agree with the data that I have seen that says that there is a shortage of inventory. But there's some analysis that we've been looking at recently that even starts to call that in question. And it starts to say, well, is there really an inventory shortage, or is it just that the big institutions had crowded out all of the retail buyers? And so it felt like, because you had two things happening at the same time, Chris. You had institutional buyers recognizing this as an asset class in the last 3 or 4 years. Three things. You had interest rates at basically zero. So those institutional buyers could borrow for nothing, and they were willing to accept a 4% cap rate on the single family rentals that they were buying, right? And you had a situation where, COVID is forcing people sort of psychologically, emotionally to accelerate their decision to buy a house, to become emotional and really want to buy now. And those things certainly made it feel like there was an inventory shortage. But I have to tell you, Chris, I am rethinking that premise.
Yeah, and you know what? It's a different type of foreclosure. So before the foreclosure happened to individuals who were not able to pay their mortgages, therefore the market was flooded with properties that banks owned. What's going to be different this time is now the market's going to be flooded with properties that these big institutional
Investors
buyers
own, right?
that these big institutional investors own. And the reason why they're dumping is because they need cash. And they see that there's going to be a downturn as a result of everything that we've talked about, the fact that there's this big cash crunch, the fact that there's going to be people out there who can't actually get mortgages because the mortgage market is in such a frenzy. So they're like, we're about to lose a huge position on value on these assets. We need to dump it now before it's too late.
Yeah.
They were in a race to do that because that's where the cash is. They spend all the cash on the properties. Right, and then
Yeah.
also one last thing, and I'll just say this, Vincent. You know, just kind of, if you have can kind of go in on this, but this is what Jamie Dimon said, which funds a lot of these non-QM, these non-bank lenders. Dimon said that the bank has shied away from servicing a lot of federal FHA loans, and this is just federal FHA loans, and these are some of the loans that these folks are originating, because delinquencies could hit 5 or 10% there, which is guaranteed to happen in a downturn. So there's additional worry that as we move into this high inflation recession, that people are going to actually stop paying their mortgages, and that there's going to be an increase in delinquencies, not on the order of what we saw before, but could these delinquencies, coupled with what we're seeing happening with these larger investors, end up leading to a flood of inventory in the same way that we saw a flood of inventory in 2008 and 2009.
Just coming from a different direction.
Right, just coming from a different direction with no lenders able to lend against these or willing to lend against these properties.
Yeah. It's a weird remix of the recession, right?
Yeah.
I don't think it will be as severe as '08. I don't think that you will see the big, foreclosures and people underwater on houses. I do think that there is real equity in houses, but I do think that prices are going to come down just because structurally all of these pressures are coming to bear at the same time.
Yeah, they have to.
They just have to. Mm-hmm. And so you got all of this money. And let me double tap on something Justin said a moment ago. It's not only that these big institutions are worried about what's about to happen, but as interest rates rise, you got to remember, if I'm a big pension fund, right? I'm a big hedge fund. I got $1 billion I got to put out. Okay. And if interest rates are really, really low, and I can borrow for cheap and go get a house that's going to pay me a 4 or a 5 cap. Yeah, historically that's low, but I borrowed the money for nothing. Mm-hmm. So it's like, cool. Yeah, I'll do that deal. I'll do that deal all day long, and the house may appreciate. So I'm happy to just flood the market. But as rates rise, and that cap rate starts to look not very impressive compared to what I could make elsewhere, it's like, why take that risk? Toilets and tenants and, having to evict people. Mm-hmm. Why would I do that when rates have pushed corporate bonds up to 5 or 6%? I'm just going to go buy some paper assets now.
Yeah. Now, I tell you two things that kind of make me nervous about this is, number one, there will be an impact to pricing as a result. If all these homes flood the market and people aren't able to buy them, then what's going to happen? They're just going to keep lowering the price until people are willing to actually lend against it because it's just such a great deal. So You're going to start seeing these homes going to go for a discount. So what does that mean for you as an investor? I think that we will hit a bottom in 2022 and 2023. And if you're in a position and ready to buy, there's going to be a huge opportunity to make a lot of money if you're in a position. So start getting yourselves in the position. This is a great opportunity, one that I wasn't able to take advantage of because I was too busy in the hospital. But now, right, we're going to, hopefully take advantage of this, and we're letting you guys know early. Yeah, that was me. That totally was me.
In 2008, that was Justin right there.
Yeah, that was me, man. So you guys will be able to take advantage of this. But I tell you, Vince, what also really kind of makes me nervous is where these investors were buying.
Oh, yeah. Yeah.
Where were they buying? And what's the impact going to be to those communities? So that right there, I want us all to keep an eye out for because they were buying in our backyards. where areas where we were raised or where we currently live. And I'm a little nervous about that.
Yeah, that's a great point. That's a great point. I hear you loud and clear. Go look at, we don't have time to go into all this today, but go look at the map of where the institution started buying. Here's a hint. They were buying where they could buy for cheap and get the highest rent yield possible. And you know what parts of the country and what kinds of neighborhoods those tend to be in. So we actually made this point on a previous episode, right? That we were talking about in the context of where credit scores are lowest in the country, et cetera, but it could have this exact impact that Justin's talking about. So look, I think that there's a play here. Again, I don't think it's '08 coming. I don't think it's as severe as '08, but listen, a glut of inventory is a glut of inventory, right? Housing price declines are declines. And the fact that it's, it wasn't no doc loans that did it doesn't really matter.
Yeah. So guys, where this really lands is, okay, now we're going to give you a bit of insight where we think you need to be focused, what we think the top lead lists are going to be in 2022 and 2023, and where you kind of need to direct your business. And here's my predictions. My predictions are absentee is going to be the #1 lead list in 2022 and 23. Because what's going to happen is that a lot of these not just institutional lenders, but also smaller landlords, when they have like some sort of financial crisis that hits, they're not going to be able to refinance. It's just not going to happen, right? Because the mortgage market won't exist. It won't be there. It'll be much harder. It'll be much harder for people who own businesses and self-employed individuals. Those loans are all going to go away. Like your ability to do a bank statement loan is going to be pretty much gone, right?
Yeah.
So a lot of these people who own these properties are self-employed. Therefore, that's going to be the #1 lead list. And these institutional investors show up on these same exact lead lists, right? And a lot of times you can't necessarily say, let me go look for Starwood, let me go look for Open Door, let me go look for any of these large institutional buyers, because they buy in all these LLCs that sometimes have names that play off of their corporate name, but a lot of times they use LLC names that don't. So if you want to get after these properties, then we need to buy lists in these areas where we see a huge concentration of investment purchases that were made in 2020, 2019, 2017, 20 in that range of years. Okay, telling you guys that's going to be the #1 list, and be ready to hop on those properties and purchase those properties in this upcoming year.
Yeah, for sure. So, listen, if you have specific questions, feel free to hop in the comments. I do want to save time for the last segment, which was a little bit of a case study, because we have a user, Christopher Campbell, who's going through a situation with a property that may be instructive for the rest of the audience. I think that you guys, and it's got a lot to it. There is the financial component, there's a family dynamic component, there is some geographic stuff that are considerations. It's a fairly complex case. And so, Chris, if you're still available, let us know if you are still down to call in. The number is 571-380-7672. Again, 571-380-7672. But in the meantime, again, if people do have questions or comments on this, feel free to hop into the comments. The last thing I'll say as Chris is preparing to call in is, not to be morbid, but you may want to follow this soap opera. It is, it's fascinating. And I'm careful with my language, because there's real people who are impacted. Those loan officers who are losing their jobs and having to figure out how to take care of their family, there are real people on the other end, but it is a fascinating drama to watch. The employees of Sprout, last thing I'll say, and then we'll have Chris come on. First Guarantee goes out of business. Suddenly says, look, we got to shut our doors. I read you the bankruptcy filing. 2 weeks later, Sprout, literally out of nowhere, says we're shutting our doors. They have an all hands meeting and they tell everybody we are shutting our doors. The business is done. It's a wrap. Okay. It comes out in the press later on that they did that, shut off people's benefits, but then clawed back the benefits to May 1, even though they had collected the premium from that period. So now there is a lawsuit pending where the employees are saying, Sprout, that was foul. You fired us with no notice. That's fine. But our insurance, you took our insurance premiums and we don't even have insurance. It is a mess. It is a mess. And I bring it up just to say that, one, it's an amazing drama to watch, but it shows you how fast, how like just lightning explosive fast things can change. They were rocking and rolling. I can show you guys articles from 3 months ago where people were touting Sprout's newest financing product, this darling of the non-QM business, how they were doing such cool stuff in the market and had technology, this, that, and the other. 3-4 months ago, that's the headlines.
Yeah.
2
And
weeks
what's
ago,
so funny?
they had an all-hands meeting and fired everybody.
And you'd show me these articles all the time, Vince, and me. Everybody knows I'm a data guy. I'm a technologist, right? And Vince would show me these articles about all the technology is so awesome and amazing, and I would always reply with the same response: "Man, mortgage is an ugly business.
Yeah.
I don't care how much technology you got in that business. That business is ugly."
Yeah.
And these guys, these Silicon Valley types, there's an ugliness to the business that they have yet to understand that they have not accounted for, and it's going to hit them hard when everything turns around. It's going to hit them.
Yeah, it's starting to hit them now. Did I hear Chris calling in?
Chris, are you there?
I'm here. How's everybody doing?
Good.
What's good, bro?
Nothing much, just listening to these stories, man. Actually, what was it, like 2004 is when I initially got into real estate, and going through the 2008 housing market crash, losing a couple of my properties during that time. I feel you, Jay. It's just ridiculous. And even going back to this case study that we're about to impinge on, how do you get financing? How do you get funding for something like this? We talk about creative lending, but when money dries up, it dries up. When risk goes up, all these companies, they clutch their pearls and snatch their purses up real quick.
Mm-hmm.
No matter what kind of doesn't matter what kind of technology you have and what services you provide. Everybody puts their money back in their pocket like, nah, I'm gonna hold on to these last $2. So thanks for the time, though. Thanks for the time, guys.
Yeah.
So in an effort not to go into like a whole another hour and a half, let me kind of rush through this. And again, this is a case study, and any information or questions or advice is welcome. This is a personal one, and thanks, Vince, for this time again. So this is my family, and I have no problem putting us out there. We know that going into probate cases with multiple family members are probably one of the most difficult wholesaling or real estate acquisition out there, because you have to get everybody on the same page, right? So I'm one of three. I'm the youngest of three. My mother died last year in September of 2021. Since then, the house has been vacant. I've been paying the maintenance fees, quote unquote, every month, somewhere around $1,200 a month. The property is in Zion, Illinois. It's just north of Chicago, about 30 minutes, and it's in Lake County. So the property value, and of course, my brothers and sisters have heard about all of these companies buying up all these properties, paying more than market value. The house needs work, not an overhaul, but the house needs work. So it's not market ready.
Okay.
So I come to them, I'm like, hey, house is not market ready, but I will give you a portion of what I think the house is worth just to buy you guys out. Because just as we know, we talk all the time, interest rates are going up. I don't want to refinance this house. I don't want to get a new loan. I don't want to go out and give money. So I was like, hey, let's just keep the house in Mom's name. We can move it over to a trust later. But I just want to buy you guys out, and you guys move on the rest of your life.
Mm-hmm.
So when I first called Vince, the house was ARV'd at about 170, 175. I just looked it up, Vince. The ARV has gone up. However, just what we got through saying, when these dumps start happening, that market value is going to go down quickly. So what I offered them was $40K each, minus the what did I price it at? 25 to 30,000 worth of repair. Need some carpet, need the basement a little bit overhauled, and a couple other things. It's rentable as is, but I offer them $40,000 a piece.
Okay.
That's $80,000 investment. with another 30,000. Let's say if I want to get it real spiffy. So we're about at 110,000. And again, we were saying the ARV was around 170. Not a bad investment.
Sure. How are you going to raise the 80,000 to buy them out?
Private money.
Okay.
I have about 20K, but I wanted straight private money.
Okay. And then so your thought was then once I get it fixed up, you would flip it, or you would keep it as a rental, or
keep it as a rental.
Okay.
I don't believe in giving away property. We've been in this business for a while. Anywhere where there's that much equity and getting rental income, that's a plus, right? And especially with this market. So yeah, my idea was to rent it out.
Okay.
That's what my idea was.
So as you are watching the market change, go ahead, Chris. Keep going.
No. So the last part was just the adversity from the siblings. So the siblings are two older siblings. Put my age out there. I'm 47. My brother next to me is 15 years older than me. That makes him around 62 this year, or 63 just turned. He just retired from UPS. My sister's been retired. She's a widow. So she just wants to cash out and get money in her pocket and be done with it. My sister's older than my brother by 3 years, so she's about 65, 66. So the dilemma is, and Vince, we didn't talk about this, what personality trait is big brother, big sister mentality, where they won't listen to the younger sibling because, of course, they can't possibly know what they're talking about, even though they've been doing this business for, what's going on, about close to 20 years now.
Right.
So that's the case study right now. So anybody want to chime in, please, by all means.
So, Justin, as you hear that, what are your thoughts and advice to him, and how might he frame what's going on and the change in the market to help him make a more compelling case to them that, yeah, we all should take this money?
Yeah, we had another case that was very similar to this. There was a deal in Philadelphia, I think, who someone called in with something very similar around trying to get brothers and sisters out of the deal and negotiate with them. Man, I don't know. There's so much nuance in how family operates and works. And obviously you being so much younger than them, I guess they always see you as the baby. But, I really don't have a strong answer. I mean, maybe you take the approach that you don't treat them like brother and sister. You actually treat them like clients. Like you actually put a real presentation together that shows them what's going to happen, and you build a story for them. What's going on in the market. You show them news articles. You basically do office hours for them at the kitchen table, and give them the breakdown of why we need to do this now. And if they see, wow, you really spend a lot of time putting this together, you really understand this stuff inside and out, right? And then I would go into a validation piece where in your presentation you present all this stuff, you build the story, and then about halfway through, or almost towards, say, 70% through, then you validate yourself. You say, guys, this is the reason I know why this is happening. This is the experience I had on this property. This is the experience I had on this property. This is what we did and how we got ourselves out of this situation. Because at this point, they've been like, man, you really know this stuff. Then you start to validate yourself, and then you do the pitch.
I love that. And now, Chris, I think that you bring in some of what we've been talking about. I know you and I chatted a little bit about the changing market, but it's only accelerated. Mm-hmm. And you may even, inject a little bit of totally legitimate FOMO, Yeah. Listen, I'm offering you guys 40 each right now. I'm not sure that I can do that 90 days from now.
Yeah, and use that webinar structure. I don't know if you guys if you watch webinars, you'll notice, and even in these little 1 minute, 2 minute commercials that show up on YouTube where somebody's trying to sell you their course, they tell you the problem and everything. They don't even introduce who they are until about 70, 80% in. They present the problem first. They start to shape themselves as an expert and display their knowledge on the topic. They make the problem really aware in your mind, and then you're looking for a solution. And then they validate why they're the ones who can actually provide the solution. So take the same
Yeah.
approach with your family. Like, don't even worry about trying to prove to them who you are. Actually prove to them who you are first through the analysis, and then validate who you are after you've shown them that analysis, and then do your pitch.
Yeah. Chris, I hope that you will keep us posted on this. I am very curious to see how this all pans out for you, and if they come around. Here's going to be the challenge for you and for anybody that's dealing with retail sellers right now. A lot of them have just gotten spoiled, and they're not watching the markets as closely as you are. They're not attending office hours. They're not seeing the I'm just saying, they're not seeing the
I know.
changing environment, and you're going to have to get them up the curve as quickly as possible for their benefit and for yours. Right.
100%.
But I think that Justin's
Thanks,
approach is a
Justin
good one.
and Vince. Yeah.
Yeah.
Just real quick, I'm going to have to redo that because, Justin, this is the reason why my circle is so small. Justin, that's exactly what I did. My first thing was a presentation. My first thing was, hey, this is what the market was. This is what the property is worth. This is what an investor is going to come in and offer you because they need to make money off of this. So 100%, and Vince did talk to me about this. Bring back the information of what's going on today.
Yeah.
So,
yeah, you got to.
the
The
FOMO is right there.
Exactly. That's the difference. Like you didn't present conflict, right? And so Michael Reynolds said, this is copywriting 101, and it is. I mean, it's part of like any way of doing a deal. You got to present a problem. It's either a problem that they're aware of or a problem that they're not aware of. They're not aware of the problem, so you have to make them aware of the problem. They don't think there's a problem. They
Right.
think that everything is great out there. They see houses selling, and it seems like everything, there's a frenzy, right? And they probably think that you're trying to take advantage of the situation.
Yeah.
On some level.
Yeah.
My nephew just purchased a house, and that's what she's going off of because my nephew pulled out of a couple deals because there was some big investment company that paid more money for the house than what he was willing to offer.
Right.
It was over market value.
Right. And
Yeah.
you got to paint the story, guys. That's gone. That's done. Let me
Yeah.
show you what's happening. Look at this article right here. This company right here that was doing that same thing. They're about to put 3,000 of these homes out in the market. Let me
Right.
tell you what problem this creates for us.
Yeah. That's right. Bring it back to us.
Right. Let me explain to you where they've been buying. They've been buying in our neighborhoods. They've been buying in mom's neighborhood.
Yeah. They're checking off the list of the things that they are unloading. Eventually, mom's neighborhood is on that list.
It's on that list because this is where they buy,
Right.
in our neighborhoods. And guess what's about to happen to our neighborhood? Prices are going to get slashed dramatically.
Yeah.
You think after these big investors back out that we're going to get upwardly mobile professionals in this neighborhood moving in paying those same prices? Not going to happen.
Tough. Yeah. It's going to be tough.
Yeah. So present the problem.
Chris, is that helpful?
100%. 100%. Thanks, Vince. Thanks,
My man.
Justin.
Absolutely.
You guys are
Absolutely.
right on target, man. I needed more
Absolutely.
brains than mine. I appreciate this.
Hey, listen,
All right.
many hands make light work, right? So consider us part of your brain trust ongoing, and seriously, do keep us posted. Call us, let us know if there's any way that we can help, whether it's information or otherwise. All right.
Thanks, big bro.
All right. Peace, Chris.
All right, brother. Good talking to you, man. All right, guys. So I think we start to bring this thing in for a landing. I guess the last vocab word that I'll throw out there today is this idea of contagion. And that's another thing that happened in the GFC. And I don't know how bad it will be this time. Again, I still don't think it will be as bad as '08, but there are elements of it already happening. I know I have witnessed, there is a deal that we were going to do, Justin and I were going to do. Big property, had a creative structure in place. The lender that was going to do the deal literally had an all hands meeting the day after the Sprout announcement. They called all their employees into the boardroom and said, Sprout just closed their doors yesterday. We are rethinking everything.
Right.
48 hours later, our loan got denied.
Yep.
Not because of us. It was all the way through underwriting. Right. All the numbers made sense. We had underwritten it conservatively. They were like, yeah, that's cool, but we don't know what the hell's going on. So we're going to pass. I was on a call with Chris Jefferson just the other day, rocking and rolling all over the country, Richmond, elsewhere. He said the same thing. Said he had 3 loans. First lender said no, passed it to another lender, said no. He ended up going to his private lenders, and even they were like, we just want to wait. We're not saying no, Chris. We're saying not now.
Yeah.
It's starting.
Yeah, it's starting. And a lot of these private lenders and hard money guys, they're basically correspondent lenders too. They're not doing they're not doing the secondary marketing thing where they're, then, selling those loans to institutional buyers who then sell it on, Wall Street. The market is a little bit smaller than that, but essentially they do the same thing. These are private lenders that have maybe backing by, say, a family office or backing by, some private pool of money that's like, say, maybe 100 million or a couple 100 million. And they'll do smaller, warehouse lines of, say, 5 million or 10 million to some of these hard money or some of these smaller hard money and private money lenders. So they're going to be feeling the same thing. Dynamics are a bit different, but the model is pretty much a correspondent lender model that we've seen in the private lending and hard money lender market today.
Yeah. Yeah. So keep your eyes peeled, guys. I hope this was helpful. Everybody do what Chris Campbell just said right there on the screen, which is like and subscribe. Like and subscribe, like and subscribe. We are opening the show up. These last few weeks, we've been doing it on YouTube, trying to really dedicate to having that be our primary venue. We will always make it accessible on Facebook to our customers, the REI Skip and REI Real customers. But we want to expand the audience. We've gotten such good feedback from you guys that it is helpful, that it is educational, that we want to make it available to more folks. So the more you like, the more you subscribe, the more you tell people about the channel, Real Estate Fiends, the quicker we can get to where we get a pretty URL, not that crazy URL that we have right now. The sooner that we can get to do some really cool things on the channel. So share this, like it, subscribe it, make comments on it. Let the algorithm know that you like this content coming from us. We certainly appreciate it. So I think that's everything, man. We're working on 2:30 already. So thank you guys for rocking with us. And I hope that it wasn't scary. That's the word that I used at the beginning. Hopefully it was more so. It was sobering.
Yeah, it's sobering, right? But it's there's opportunity in everything.
Yeah,
so if you
there's
know
opportunity
how
in everything.
you know how to play the game. You can win. It's a game.
Absolutely, it is a game. You just gotta learn the rules. So we love you guys. We appreciate you. We hope that whatever you do, you're being careful out there. COVID is not gone just yet. So be careful, mind your health. But whatever you're doing, please don't punt on the weekend. Do something to move your business forward, even if you just go and watch this show again to unpack some of the vocabulary that you missed the first time, or read some of these articles. We put a bunch of them up on the screen. So we love you guys. We'll see you next Friday. Y'all be good.
Thanks, everybody. Love y'all.
Peace. You see, I'm trying not to get us kicked off of YouTube no more.
I appreciate it. Yeah. Music's not as good, though.
It's not as good. I know. It's just not, man. I'd rather be playing Frankie Beverly, but
but
what are you gonna do?
Now we playing Slanky Meverly.
Not Slanky Meverly. Not him. He's whack. Oh man, the beat is fire though. Beat's fire. Anyway, we love you guys. We'll see you next week. Y'all be good. Peace.